Hey everyone, welcome again to our next event with the Auburn Alumni program that we have here at Merit Financial Advisors. I'm really excited that you are joining us and want to thank you for your participation today. A number of you are joining us live, so thank you for that. You may be watching this on our recorded version, which we'll send out after the event as well, so thank you for your participation also. Today we want to cover a very important topic that affects all of us, both from an investor standpoint and in my job every day and working with clients such as yourselves, and that is, what is your financial personality? And really that's important when you think about the decisions that you make when it comes to investing, how you handle money in general, budgeting, where your money is spent, the risk-reward aspects of how you handle money. There's behavioral biases and what we refer to as financial DNA that makes up those decisions of you personally, and the emotions behind that, and what really drives some of the actions that you make when it comes to where your money goes and how you handle money. So we want to dive into those variables today and what makes up again, what your financial DNA is as far as how you handle money. So today there's 5 main points that we want to look at. What is behavioral finance? What defines that for you specifically, and why is that important for you to know? What is your personality type? Your personality is unique to you, and that certainly influences decisions that you make in all aspects of life, certainly when it comes to money as well. What are your behavioral biases? What conditions do you have in life that make or influence how you make decisions when it comes to finances? What is your risk tolerance? What is your risk return mindset? And how do you handle volatility? How do you handle loss? How do you handle gains? Those are important mental aspects to be aware of as well. And then how do we apply this knowledge to decisions that you might make when it comes to investing, how you spend money, and just general financial behavior overall. So I hope this will be very valuable for you. We'll look into these different dynamics of these 5 points as we go forward here. First of all, what is behavioral finance? Well, in defining that, you have to understand it's really the psychological background of what makes decisions prudent for you as an investor. So the influences in your life, the biases that you have in life, really these are instrumental in helping you make decisions that might be both positive and negative. And the positive aspects are really things that you want to embrace as far as your personality and your financial behavior and DNA. The negative aspects are areas where you want to be aware of the tendencies that you have so that you can avoid those and maybe make better decisions going forward as it results to your financial investing, how you handle budgeting, and all the important decisions that you make with respect to money. So behavioral finance is a really key driver of that we want to hone in on today. When we talk about the building blocks of your financial DNA, this is really 2 primary components that we want to focus in on. And on this slide you'll see on the left-hand side a picture of an iceberg. And I want to focus on the bottom half of this first. This is really your natural behavior. When you think about this, this is all the building blocks that you are innately designed with, right? And this means parts of your value system, how you value risk reward, how you value the end results that money can derive for you as far as what you can achieve with money, your passion and visions when you think about what you want to achieve in life that are impacted by your investing and finances. What is your environment? What is your upbringing like? Your family life? What was that like as it relates to money and how you were conditioned or taught about money? When you think about your different personal financial attitude and how your current environment within your life frame, how that impacts financial decisions that you make. Your needs and wants. Obviously money is a tool that drives decisions that we make to achieve certain things in life with respect to goals that you might have, needs that you have from a budgeting standpoint, but also big picture items that you might be saving for and investing for, another house, college education, vacation, or retirement related end results that might be important to you. And then your general knowledge of investing and finances. Obviously that's different for everyone as far as your experience and what makes up your knowledge base when it comes to investing. All of these are natural traits or behaviors that build into your decision making. So that's really the bulk of this iceberg, if you will, that you rely on when it comes to making decisions financially. On the top half, you'll see the learned behavior, which is just as important, and that's really contingent upon your experiences in, really your adult part of your life, as far as different decisions you've made, the outcomes of those decisions, and what lessons you learned from those. So if you think about an investing decision you might have made in the past, how did that turn out? Was that a positive experience? Was it negative? Was that a rewarding experience, or did you experience losses in that type of investing decision? Or maybe it wasn't investing, maybe it was a spending choice that you made. You bought something that you anticipated would derive a certain level of value for you. Did it in fact provide that value, or did it feel underwhelming after the fact? Were you satisfied with that decision? Were you unsatisfied? So all these are conditional situations where you've learned something along the way that has determined your decision making going forward. And so these are important aspects to be aware of, because again, these drive current and future decisions for you financially, and you want to be aware of how those might be positive or negative to you and embrace those. When we think about predictions about what's going to happen in the future, it's important to look into the past. And so this is a sort of cartoon that might relate to a lot of people. It says, when will it be okay to feel irrationally exuberant again? You might have heard that phraseology before. That was actually coined by former Fed Chairman Alan Greenspan back in the late 90s, when the dot-com era was really on fire, and really the market became very frothy and overvalued, and the smart people, if you will, were realizing that perhaps things were getting a little irrational as far as the markets were concerned, and people's perspective on those. So this is just a cartoon that kind of relates to that. And some of you might have this mindset when it comes to investing and how you view the markets. There are certain psychological impacts or processes that we all operate on when it comes to investing. Some of us get very excited when the markets are doing well. Some of us are more nervous. Regardless, we tend to be very sour when the market is more negative, and sometimes that can be an opportunistic time frame. So we'll touch on that a little later as we go as well. When you think about your financial personality, this slide really, I think, does a comprehensive job of showing you where you might land on the spectrum of your personal financial DNA. And that's actually a service that we offer for our clients and relationships that we have. It's certainly available to you as far as taking this financial DNA personal assessment. And that assessment will give you this feedback that you see on the screen right now. So on the top half of this, you see those individuals that might be more fast-paced oriented. Whatever the end result is that they are looking for, they want to get there sooner than later. And on the bottom half, you'll see those that are much more cautious. They're much more analytical. They're slower to take action. They really want to see all the options before they make an ultimate decision, and are just more patient when it comes to that end result that they're striving for. On the left-hand side, you'll see different characteristics or personality types that are focused on end results. However fast or slow they get there, they're really focused on what is the end game here that they're really trying to achieve from a result standpoint. On the right hand side, you'll see personality traits that are really focused on relationships, dealing with other people, or affecting other people in their decisions, or what do other people think about the decisions that they're going to make. So everyone is unique when it comes to this, and in the top or in the corners of this, you'll see maybe the different personality traits that characterize yourself among these different sides of this chart here. So are you more risk focused as far as taking risk, or are you someone that avoids risk more? Do you move on your own more, or do you tend to follow the herd more? Do you operate from a standpoint of fear or opportunity? Are you more focused on growth of your assets? Are you focused on not losing money when it comes to investing? So each of us are unique and different when it comes to the financial DNA that makes up your decision making when it comes to investing and handling money, in general otherwise. What I'll tell you is that in my role as a financial advisor, my financial DNA, and I've taken this same assessment that I encourage you to take, is one of being an influencer, which is at the top middle of this chart here, which is not really a surprise given what I do. That kind of fits where my mindset is. So I'm very, I'm leadership inclined. I want to be a leader for clients and help them achieve, their end result. I'm focus on my communication skills when it comes to working with clients and other relationships such as yourselves. I'm focused on really the result side of things, getting an execution strategy in place that we can take action on, and really what the end result is for a client that we're working towards. So I'm focused on influencing and leading people to the end result that they're looking for. What does that mean? There's negatives to that perhaps as well. I'm less comfortable if I'm not in a leadership role. I like to have things under my influence for the benefit of where I see that benefits a client. So I'm probably not as apt to let someone else lead in that regard. I might be a little too direct when it comes to providing influence and advice to clients. At times I try to be very personal with clients and help them see the big picture and understand their pain points as well, and be patient on that. But at the same time, I might be a little too direct in telling them what they need to do. I don't know, that may be positive or negative for you, but that's what makes up my financial DNA. So in fairness, I wanted to share that with you. Let's look at Albie's financial DNA. We can all appreciate Albie and where he may land as far as the financial DNA aspect of things. Albie is most definitely a community builder. When you think about Albie, that certainly fits for him. What are those strengths for him? Well, he's very outgoing. He has a limitless supply of energy, and that is certainly palpable when you're around Albie and know what he's all about. He shares that true sense of belonging and being on the team, and understands the importance of this. And Albie, like no other, is very much a team builder, and wants to be around others and building up that family atmosphere. What are struggles for Albie? Well, Albie tends to feel isolated when Auburn football is over, and maybe he doesn't have a team to cheer on. He's looking for something to do because he's got all this pent-up energy and wants to get somewhere with that. Albie gets a little hangry if Mama Goldberg's isn't open and he's really ready to eat as well. So Albie has to feed that energy, and he needs some good Mama Goldberg's to do that. So I know we can all relate to that in our time at Auburn. So wanted to check on Albie there as well. Moving forward, it's important to understand again how those DNA profiles relate to you personally. In other words, how does the influences and biases that you have impact the decision making that you have when it comes to investing? And so on the chart here, you'll see two different lines of progress when it comes to investing. So the green line at the top is related to stock investing. And as we know, stocks carry a certain degree of risk that has a degree of reward over time. In a short period of time, you might see losses, and you want to understand how you respond in those periods of loss or negativity. But in the long run, statistically, we know that stocks do provide a greater opportunity for return. So can you weather out the short-term or intermediate-term impact of risk, understanding that over the long term, that risk will have its rewards in greater gains if you have that type of time frame in your investing objective. The blue line on the bottom relates to cash, or let's call that more conservative investments. If you're more patient, if you're more slow or cautious or risk averse, you might invest closer to this line, and you want to understand the dynamics of that. More conservative investments are going to have less volatility, less risk impact. And while that might help you sleep at night, you have to understand the negative side of that is that you're not going to have the same level of growth over the long term. And so the blue line, the cash or more conservative type investing, shows that. And there's a significant gap when you look at investing over a long period of time as stocks compared to cash, or again, more conservative investments. So there's positives and negatives to both sides. Stocks carry more risk of loss, but over the long term, they will return greater returns than cash, which cash or conservative type investments will have far less risk, but you can't make as much. And so there's a balance here. There's a dynamic that you want to be aware of, where you're comfortable with, and where that balance will help you meet your needs going forward and your needs for the future, such as retirement, which is big for all of us. So Beyond our natural behavior that we've talked about, again, we have these biases that we want to be aware of. We looked at that iceberg earlier, the biases that are, a function of our learning experiences, our conditional experiences, decisions we've made or things we've been through that create biases for us based on our conditional learning. And so here are some common behavioral biases that you want to be aware of. And think of different market circumstances that could arise where these biases might come to the surface for you. Are you overconfident in a certain market situation or less confident? Do you have an optimistic viewpoint overall, or do you have a fear of regret? That regret could be both sides, a regret of losing opportunity or a regret of loss that will keep you from investing. Are you a herd follower? Do you invest on your own independent of any other factors? Or do you go where the herd goes? What we know is that money tends to flow into the market when the market's doing very well. And money leaves the market when the market is down. Now that might seem natural and logical, but it really can be counterintuitive to what would provide the most opportunity for you. And we'll look at that in a couple of slides here. Are you more concerned with growth, or are you more focused on not losing money? Which has more value to you? Which helps you sleep at night? How do your needs and your experience affect your decision making? Do you tend to overtrade? Are you a buy and hold type investor? Do you need research and understanding before you make decisions, or are you just instinctive and more off the cuff with your investing decisions? All of these are biases that affect the execution of how you invest and how you handle money in general. So you want to be aware of these, because some of these can lead to positive experiences and actions. Some of them can lead to negative or inopportunistic actions. And so if those decisions might put your growth or your future plans in peril, you want to be aware of that so that you can counteract your natural biases. If some of your biases might put you at more risk than you're comfortable taking, or really should be taking, again, you want to be aware of that as well. So the end result here is important, but you want to understand how your behavior and biases get you there. This is an example of the herd follower. This is my scrapbook of losing lottery tickets. To my point, as far as risk return, think about the lottery. When the lottery is multiple millions of dollars, what happens? More and more people play the lottery. Probably statistically the best time to play the lottery, which there is no statistical good time to play that obviously, but is the best time might be when a huge jackpot has finally just paid off. That first week after that, when the lottery is at its lowest amount, statistically has the fewest people playing, which means that's the best time for you to play. But let's be honest, most people follow the herd, and you might do the same when it comes to investing. Think about the pattern of the markets as it goes up and down. When it's up, there's more positive aspect of investing, a better mindset, and people tend to invest more in those time frames. Maybe that's like you, maybe that's not. The counter side to that is risk tolerance, right? Or what goes along with that. Risk tolerance is the risk return spectrum of how you invest. What is the return that you should get for the level of risk that you're willing to take? And what are the consequences of that risk if the returns don't pay off? So for you, again, I've touched on this, you want to think about what makes up those decisions for you. If you need to grow at a pace of like 8% a year over the next 20 years to hit your goals, you have to understand that there's a certain risk variable that you have to take on to pursue that level of returns. In the short term, that risk might mean losing a decent amount in your investments. How would you feel? Do you understand that you're investing for the long term and you can kind of shrug that off? Or does it really just not sit well with you and you don't sleep at night during those short-term periods of volatility that might arise? So you want to be aware of that. You want to understand your potential conditioning and those biases as it relates to risk and reward, and understand how that influences your decisions positively and negatively, and maybe some changes in your behavior that might be warranted when it comes to that. So let's look at different risk return ratios or mindsets, if you will, when it comes to investing. On the left-hand side, let's start with the bottom row there. You'll see portfolio structure, and on the far left, you'll see capital preservation and much more conservative mindsets when it comes to investing. On the far right, you see more growth or aggressive related investing and where that falls on the spectrum. The percentages in the middle column there are showing you what percent of the population are comfortable taking a risk level at or below those different quadrants, if you will, on the spectrum. So for instance, Group 6 is a growth-focused investment strategy or mindset. That means you're pursuing higher levels of return, which brings with it higher levels of risk that you are comfortable or need to be comfortable taking if you're going to pursue that level of return. What the statistics tell us from Financial DNA is that between, call it 84 and 98% of those individuals are less comfortable with this level of risk, or at least no more comfortable than this level of risk. So that obviously puts you in a very smaller subset of the population when it comes to being comfortable with this more growth aggressive form of risk as it relates to investing. On the left-hand side, obviously, the more conservative you are, you might be in the minority on that side as well. So we find that investing, people that have at least 5 years or more to invest, meaning a financial goal of retirement that might be 5 years away or more, tend to be in perhaps Group 4, 5, and 6. They know they need to have some degree of risk to reach those returns, and they need to be comfortable taking that. So ask yourself, how do you feel comfortable, or what point on this spectrum do you feel most comfortable with when it comes to investing? Obviously, in reaching our goals, we want to be able to take as little risk as possible that would still allow us to reach our goals. But the reality for most of us is that we need to take some degree of risk to get to our end results that we're working towards. And so this is a good dynamic to look at and just kind of be aware of as far as where you fall on that spectrum. When it comes to the dynamics of risk and return and the way that the market results in these types of aspects, you want to be aware of how frequently you might see a downturn in the markets and how deep a downturn that those cycles might result in. So this is a chart going back to 1950 through 2019, and what you see here is declines of 5%, 10%, 15, or 20%. As far as different levels of declines that might happen in the markets. And this chart is really designed to pique your interest around what you might be comfortable with when it comes to investing, these types of declines. So for instance, a 5% or more decline takes place around 3 times a year on average. The average length from the top of the market to that bottom of that 5% decline can take around 43 days on average. And the last one of these, at least through this chart in 2019, was in August of 2019. Now, if we include last year, obviously these numbers would be updated. We had the market decline through the pandemic last March, and really all of these were triggered at that point. But again, just in looking through 2019, a 10% more or more contraction happens about once a year and usually takes about 112 days from top to bottom. 15% or more, and let me back up, a 10% decline is technically what we call a formal correction in the market. So if you hear that terminology used on TV or CNBC somewhere, or if I refer to it, a correction in the market, that means a decline that has taken place of 10% or more in the market for you to be aware of. 15% or more happens about once every 4 years or so. It takes about 260 days to happen. And then a 20% or more decline is what we call a bear market. So that's a more serious decline. Those happen in general, on average, about once every 6 years. We've actually seen a couple in more recent time frame than that in the last few years. Those typically take about 401 days from top to bottom. Interestingly, the last bear market we had in March of last year, again going off chart for a second here, March of 2020 when the pandemic set in, if you'll recall, that was a very, very fast crash that set in really about 6 weeks from top to bottom when we finally understood the negativity of the pandemic and how that was setting in. So it can be very fast, but on the whole, on average, it does take quite a bit longer than what we experienced last year. So these are just statistics to be aware of. I do want to spend some time on this slide for you because this really relates to the psychological nature of how we invest. And if you look at this chart, and I'm going to try to point to some points here of interest that I think are important for you to be aware of. we talk about the herd mentality and how we really only take action if action would have risk. We really tend to only take that risk if we see others doing that herd mentality that we talk about. So think about the lottery. When the lottery's big and everybody's playing it, again, you're more inclined to play it in that aspect. When the market's doing very well, we have this fear of missing out. We want to jump in and participate in the market just like everyone else is, because we want to make money like everyone else is. Well, when the market's doing well and is growing very strongly, that can typically be when the market is maybe nearing the peak of its cycle. So in that aspect, you might have emotional feelings of excitement and thrill or even euphoria when this is what's driving action or driving you to put money into the market. Maybe you've had some cash for a while, and when everything is really going well, you're like, okay, I'm ready to invest because everybody else is and everybody is seeing positive results. Well, the reality of this is it might be actually nearing the point of maximum financial risk at the top of the cycle here. And so again, euphoria drives that activity, but it might be actually the best time to be selling out of the market in reality at the top of the cycle. And so, but if you buy in at this point, or you are invested at the top of the cycle, it might feel great, but as that cycle rolls over, you might start to experience points of anxiety as you see losses start to happen. As those losses build, you might be in denial, meaning it's like, well, this will come back. I'm going to stay in the market, or as it gets worse, you'll see fear and maybe panic start to set in, and then eventually you get to a point of market capitulation, and you're like, I can't take any more. I've got to get out. And many of us, again, the psychological nature is that we will sell in this point of the cycle right here. Well, when you look at that in the big picture, that actually becomes the point of maximum financial opportunity, in theory at least, if this is the bottom of the cycle. So think about March of last year when the pandemic set in. The market was off about 35% in 6 weeks. When that set in, everybody's pulling out of the market. But in reality, if the market's down 30-35%, the likelihood of recovery from that type of decline is pretty high. And so that really offered the opportunity of maximum growth potential, in theory, from that point forward. And that's exactly what happened. We saw from the end of March through last year, the market was essentially straight up. So if you had the wherewithal to understand the cycles and go against your natural psychological behavior, or that of investors in general, you would have seen this point in last March as a really good point to put money into the market rather than taking out. So you want to understand the cycles, you want to understand the psychological tendencies that you have so that you can make more sound decisions that may in fact go against your normal financial or psychological inclinations and those of investors overall. It's really important, and that's part of my job, to help investors see the big picture and not make emotional decisions that could be detrimental to them in that particular point. When you think about that, you want to understand the risks of moving in and out of the market at the wrong times. So this chart shows us the 10-year period from January 1st of 2010 through the end of that decade at December 31st, 2019. If you had invested $1,000 in the market January 1st, that would have grown to, at the end of that decade, roughly $2,897. Just for the math on that, there is roughly 2,500 trading days in a decade, maybe a little more than that, but about 2,500 plus trading days across a 10-year investing cycle, if you will. So if you had been invested in all those trading days, you had bought and held throughout that decade, your $1,000 would have almost tripled across that 10-year period. If you are more susceptible to moving in and out of the market at the wrong time, think about this. If you had missed just the 10 best trading days in that 10-year period, and again roughly 2,500 trading days, if you missed just the best 10, your gains would have been cut significantly, down to about $2,000. So you would have lost a third of your money if you missed just the 10 best days there. If you missed just the 20 best days, your gains would have been cut in half, in fact. And you'll see 30 and 40 best days, you're really looking at a losing venture by just missing a handful of days when it comes to the overall trading days that make up a decade. So if you're going to move in and out of the market, you want to understand the impact of your losses that you could potentially derive from the poor timing that might result in. So it's just really important to see this big picture here. So when we think about strategies for dealing with market volatility as opposed to trying to time the markets, here's some things that I want you to think about. First of all, invest regularly. If you're participating in a 401k currently, you understand that you're putting money in there every pay period. That's great to help mitigate some of the volatility. It also helps just make the balance in your 401k look like it's constantly moving up more and more because obviously you're putting money into it regularly. That will help as far as your tendencies to move in and out of the market in good and bad times. You'll stay regularly as far as you're investing there. Obviously avoid jumping in and out of the markets. You're not going to get timing right. We've covered that. Maintain a diversified portfolio. The goal here is that at any one point in time, some types of securities will be doing well, some will not. You never know what that timing will be for those different types of investments. A diversified portfolio will spread that risk out and allow you to broadly participate in general gains over time. Don't forget history. Again, going back to our learned behavior, not only market history and what the history tells us as far as returns over the long term, but also your personal history. What decisions have you made in the past as it relates to investing? What has happened from that? What did you learn from that? How that affects future decisions that you can make when it comes to investing and handling money overall. And then obviously talk to a financial professional. Think about it like this. Whatever you do in your daily career, I have no clue about. I wouldn't be able to step into your shoes and know exactly what to do or even remotely what to do to be successful at your job. When it comes to investing, if it's not your day job, there's only so much you can research and educate yourself and learn on to be effective as far as investing. A financial professional really has the wherewithal and experience and knowledge to provide good guidance there for you and help you understand the nature of impact of decisions that you might make and give you good advice when it comes to those decisions. So be mindful of that and just kind of be humble enough, I guess, to say, hey, here's what I know, here's what I don't know, and let me seek out the right professionals that could give me good advice and guidance otherwise. So what's next? Well, as it may make sense for you, feel free to schedule an appointment with me. My focus here with our Auburn campaign, again, if you've seen my prior messages to you, is really just want to build some connections with you and build out relationships that I have here with the Auburn alumni family in Atlanta. But obviously I'm a resource that potentially could be beneficial for you in providing some guidance and at least a consultation where it may make sense to help you evaluate your personal investing and finances. If that makes sense for you, I'd love to have an opportunity to sit down with you and have that discussion. We are going to include the financial DNA assessment with this communication, so I would encourage you to take that. If you do, we'll get the results and we'd be happy to share that with you and have a meeting to kind of walk through what that means for you so that you understand your biases and tendencies and conditional behavior that makes up how you look at investing in the current situation. Create a long-term plan that really accounts for your financial personality. If you take that assessment, get a better viewpoint on how you tend to operate when it comes to investing from a financial behavioral standpoint, then with that knowledge you can make a much more specific financial plan that incorporates your tendencies and your financial behaviors, and that would obviously lend to a more predictable and higher likelihood of success as far as your future goals that you're working towards. And you want to monitor that process as well. You can do that on your own. We can help you do that as well. There's different levels of engagement that we can explore together as that may make sense. So again, we welcome that just as a part of our engagement and pursuit of relationships with Auburn family like yourselves. And then at the end of the day, obviously we're looking forward to the fall and football season, so we're all excited to cheer on Auburn this year. It's going to be, again, a very curious year with Coach Brian Harsin and his staff leading us and what that may mean, the different direction that the team may take. We're obviously hoping for good things there as well, so we'll cheer them on together. So in conclusion, thank you again for your attention and participation in our webinar today. Again, some of you are watching the recorded version of that. This is being sent to each of you that might watch this. If you do take the opportunity to review this webinar, we'll see record of that, and we're going to include you in a raffle for the fan box that you see here from Fanatics, which has got a lot of great Auburn gear in that we're going to give away. And so just as a thank you for your participation and just to give something back in our engagement with you. So hope you'll take the time to watch this and look for those results as well. You also will see ways to communicate with me and reach out to me in the communication that sent this webinar recording to you. So feel free to reach out if I can be of assistance, and even just have a candid conversation or meet you for lunch or coffee at some point. Again, my goal is just to make great Auburn connections, and I really look forward to doing more of that. So with that, I thank you again for your attention and look forward to speaking with you the next time we can come together again. Until then, War Eagle.